Good morning. We will pay attention to VAT today. The entity uses the perpetual inventory system that indicates to us that we will have to calculate the cost price and complete a double entry for sales price and a double entry for cost price when goods are sold or returned. The profit of 50% on cost price is maintained. They use control accounts that indicate that you have to show that the account debited or credited is debtors control or creditors control. The owner in grey increases capital contribution from 120 to 160. If they said he increased his capital contribution with 120,000, then the amount will be 120,000. He increased it from 120 to 160, so the money received is 40,000 rand. The account debited is bank because the money is deposited into the bank that increased the assets with 40,000. Capital is credited because owner's equity increase on the credit side. The owner took goods with a sales price of 513 for his personal use. If the sales price is 513, VAT is included in the 513. So we have to take the VAT out to determine the sales price excluding the VAT so that we can determine the cost price. The sales price including the VAT is 114%. The VAT is 14%. And the sales price, that's the income for the business, is 100%. The owner took goods with a sales price of 513, so it includes the VAT. So if we want to know what is the sales price excluding the VAT, we will use the 513 Rand times 100 divided by 114. And that will give us 450 Rand. So our first step is to determine what is the sales price excluding VAT. Then we work out what is the cost price. The cost price equals 100%. The profit equals 50%. And the sales price equals 150%. The sales price equals 450 Rand. So if we want to know what is the cost price, 450 times the one that we want, 100, divided by the one that we know, 150, and that will give us 300 Rand. So for the second step, we calculate what is the cost price excluding VAT. But because the owner is taking goods for himself, he has to pay VAT on these goods. So the sales price excluding the VAT equals 100%, and that equals the 300 Rand. If we want to know what is the VAT, we want to calculate the 14%. So 300 times the one that we want, 14, divided by the one that we know, 100. And that will give us 42 Rand. So to do this entry, you have to do 3 separate calculations to get to the figures that you have to use. The drawings account is debited. That will reduce the equity with a 300 Rand cost price. The inventory account is credited because we've sold inventories and we reduced inventories, so the asset decreases with the 300 Rand. Drawings will also be debited. That will reduce the owner's equity because the owner has to pay VAT on these goods, the business treats it like selling goods, collecting VAT on behalf of SARS, so they credit VAT output to indicate that the liabilities increase with 42 Rand. The alternative method is where we buy goods, we will debit the inventory account with the purchase price, say for instance 5,000 Rand, and we will debit VAT input to indicate that we will claim the VAT back from SARS. Now, if the owner takes goods for its own use, it means that we will decrease the inventory because the inventory is not available for the business anymore. And then you can say that because the business can't claim the VAT back anymore from SARS, VAT must now be paid on this 300 Rand, that you will credit VAT input account with a 42. So it means that you decrease the total amount that can be claimed back from SARS. The method that we did in this example is where we credited VAT output. So in that case, you say that the business sold the goods to the owner, collected VAT on behalf of SARS, and therefore you will show that you owe the money to SARS. In both ways, you will transfer the VAT input and the VAT output to the VAT control account, and you will get the same amount that must be paid over. So some textbooks will show it as VAT output, and some textbooks will show it as VAT input. Sold goods to D. Shepherd on credit 9690. That is the sales price. So to determine the cost price, we have to remove the VAT out of this amount, and on the reduced amount, excluding the VAT, we will determine the cost price. So the sales price, including the VAT, is 9690. That equals 114%. VAT output will be taken out of the amount. VAT output is 14%. So the one that I want, 14, divided by the one that I know, 114, times the amount gives me the VAT as 1190. The sales price, excluding the VAT, will be equal to 100%. So 100, the one that we want, over the 114 that we know, gives me 8,500. So we will calculate the cost price on this 8,500, and the profit was made on cost price. So the cost price, the one that we want, is 100%. The sales price will be the 100% plus the 50% profit. So the sales price equals 150%. And then we get the cost price as 5667. The debtors control account will be debited with the sales price because that is the amount that they owe the business, and assets will increase. Sales will increase the profit, therefore the equity will increase because the owner will get a bigger profit. On this debtors control, you will also debit the debtors control because they owe the VAT to the business as well, and you will credit VAT output, indicating that this VAT must be paid over to SARS, so that is a liability for the business. So the entry for debtors control will be done at sales price because that is the amount that the debtors owe, the sales price and the VAT. The cost of sales will be debited with the cost price to indicate that the profits will decrease and equity will decrease. We sold inventory, so we reduce the inventory on the credit side to show that assets decrease. A debtor returned unsatisfactory goods with a sales value of 2052. When we sold the goods to the debtor, we did two double entries, one at sales price and one at cost price. When the debtor returns goods, we also have to complete two double entries. This 2052 includes VAT, so we will have to take the VAT out to determine how much VAT can be claimed back from SARS, because now we didn't collect this VAT from the customer. The sales price including the VAT equals 114% and equals the 2052. The VAT is 14%. So if we want to see what is the VAT inclusive in this amount, the one that we want 14 divide by the one that we know 114, and that will give us 252. The sales price equals 100%. That is excluding the VAT. So if we want to calculate the sales price income of the business that's going to be reduced, then it means the one that we want 100 divide by the one that we know 114, and that will give us 1,800 Rand. Debtors allowances is used to reduce sales on the debit side. So that means that my profit will decrease because the goods are returned at sales price and the owner will get less profit, so equity decreases. The debtors control will be decreased with the amount, so assets will decrease because they don't owe us this money anymore. We will debit VAT input, or we can debit VAT output depending from which view you are looking at it, and you will show that that 252 can now be claimed back from SARS. Then we have to calculate the cost price. The sales price is 1,800. That's excluding the VAT, so that means it's the 100%. So the cost price will be the one that we want 100, divide by the 150 that we know, and that will give us 1,200 Rand. Inventories are returned, so inventory increases, assets on the debit side. Cost of sales, the expense is decreased on the credit side, and when the expense decreases, the profit increases with 1,200. ABC Suppliers issued an invoice to penny stores for goods purchased at 3838 less 10% trade discount. So we have to deduct the trade discount because we're not going to pay that amount, to see what is the total purchase price that we will pay for the goods, and then we have to work out how much VAT is included in this figure. The cost price is 3838. We subtract the 10% discount 384, and that will then give us 3838 minus the 384, and it equals 3454. That is the price that we pay for the goods including the VAT. So it includes VAT, giving us 114% equals 3454. The VAT that we want is 14% divided by the 114 that we know will give us 424. The cost price of the inventory will be exclusive of VAT. So the 100% that we want over the 114% that we know will give us 3030. Inventory will be debited because assets increase with the purchase price excluding the VAT. Creditors control will increase on the credit side and increase liabilities. VAT input is an asset because we can claim the money back from SARS, so assets will increase. We also owe the VAT to the creditors, so creditors control is credited and the liabilities will increase. When we sell goods for cash, it means that we will record the amount in the bank. If we sell goods for 5,700, we will increase the amount in the bank with 5,700. Of this 5,700, 700 must be paid to SARS for VAT collected. 5,000 will be transferred to the sales account to show that the income for the business is 5,000. So the sales account is a 100% account. You're not allowed to show the VAT as part of your income. In the bank account, the amount recorded is 114% because the amount that we receive is the income of sales and the 700 Rand that we have to pay as VAT output, and VAT output is a liability for the business. So this 14% account is a liability because we have to pay the 700 Rand over to SARS. If we purchase goods for cash, we will indicate that we buy for 1,710. So the amount that we will record in the bank will include the VAT that we pay for the goods. Then we will indicate that we buy the goods and the value of our inventory will increase with 1,500 excluding the VAT. Because we can claim the VAT back from SARS, it means it's not part of the cost price of the inventory. So inventory is a 100% account. And we will open a VAT input account to indicate that we create an asset because we can claim the 210 Rand back from SARS, and this 14% account is an asset. So if we look at this, we see that the bank account is a 114% account. All the other accounts are 100% accounts. The same will apply if we sell goods on credit. In the debtors control account, we will indicate that the debtors owe us the total amount. So I will show 2,280. That 2,280 includes the VAT. So the debtors control is a 114% account. I will take to sales 2,000. So my income will only increase with the money that belongs to the business. The 280 will be transferred to VAT output to indicate that that money is outstanding and must be paid to SARS. So the debtors control is also a 114% account. If we buy goods on credit, we will open a creditors control account, and in this creditors control account, we will show that we buy goods for, say for instance, 1,700. Okay, that amount that we owe there to the creditors includes the VAT. So the creditors is a 114% account. The amount that will go to inventory will be 15,000. So that is the cost price of the inventory excluding the VAT. And then we will show that we can claim 2,100 back from SARS. So that's an asset to me. So the only three accounts that we have that are 114% accounts are bank, creditors, debtors. All your other accounts will be 100% accounts. So you can never show VAT in any income or expense account. You always have to take the VAT out. So any income and expense that's recorded in your income statement will exclude VAT. The same in the balance sheet. All your assets and liabilities will exclude VAT except bank, debtors control and creditors control. All the other entries will not include VAT.